Hey guys, welcome back to the channel. In today's video, we'll talk about hedging and how a trader or investor can hedge their positions to minimize or maybe completely offset their losses. This was a topic suggested by a subscriber, and if you want any particular topic to be covered on the channel, make sure to let me know down in the comments section. And personally, as traders, we use hedging a lot because if you are into options or futures, it is a must to hedge your positions against maybe unlimited losses or any unforeseen event like maybe the upcoming US elections. You never know what happens, it might lead to a big gap up or big gap down. So it's always recommended, especially in such situations, to be hedged. And if hedging sounds interesting to you, make sure to stick with me through the entire video. And without any further delay, let's start the video. So guys, first we'll cover what exactly is hedging and why should a trader or investor hedge their positions. Hedging is a form of insurance against any uncertainty. Losses can be minimized through hedging. As we all know that March was entirely filled with uncertainty and coronavirus had a very deep impact on the markets on the downside. Nifty fell more than around 4,000 points, which was a bizarre situation for an investor as well as a trader because it was very risky. Now, how can one be protected from such an event, or maybe at least how to minimize or offset their losses? This is where hedging comes in. Hedging is a risk management strategy used by traders and investors both. Traders use hedging a little differently than investors use because investors have a long-term perspective, whereas traders are generally very short-term traders. But it doesn't mean that hedging is entirely different for both of them. It is quite similar, but the usage is a little different, which we'll discuss further in this video. Hedging uses derivatives such as option contracts and future contracts. So if you want to hedge, you can either use a call option or a put option, or if your conviction is very strong about a direction, you can even go ahead and use futures. Now we'll talk about how does a trader hedge and how does an investor hedge. First we'll cover how does a trader hedge. So let's say I'm a trader and I'm bearish on the markets one day before the US election. Since this video is being recorded on the 3rd of November, which is a day before elections, and I am bearish on the markets. I want to capitalize on my view and make money. That's all we are in for. As traders and investors, we all are here to make money, right? Now Nifty is at 11,813 at the closing price of 3rd November, and I don't expect 12,000 to be breached even if there is a good surprise on the upside of US election. So what I do, I just sell a 12,000 call option, which makes me completely risk prone on the upside, because you never know how the markets react and there might be a huge movement on the upside. So I'm completely risk prone towards the upside because I've sold a naked 12,000 call option. And if price starts moving above 12,000, my risk is basically unlimited. Now what can I do? Since elections are an uncertainty and anything can happen, what I do is I buy a 12,100 call option to hedge the 12,000 call option so that the loss is minimized if we get a surprise to the upside. What will happen, say for example the market opens 5% or maybe 6% on the upside. If I have a naked 12,000 call option short, I will be in trouble if the markets go up by 5 to 6% because I'm completely exposed on the upside. But what will happen if I cap it with 12,100 call option that I've bought? My max risk is 100 points. Why? Because the space between 12,000 and 12,100 is 100 points, right? So this is how a trader uses hedges. Now let's dive into how an investor might use an hedge. Now let's assume that I'm bullish on Reliance for the longer term, just an example, and I buy 500 quantities at 1900 seeing the recent fall and the fundamentals look good to me. Just for your information, I'm not a fundamental guy, I'm just mentioning this as an example. And 1900 levels look good to me, so I have bought 500 quantity of Reliance at 1900. I fear that the results are not too good. This quarter's results that have come out recently are not that promising and Reliance might fall for the short term, but I'm still bullish over the long term because I have a belief on Mukesh Ambani that he will run the company very gracefully, and basically I don't want him to get rich alone. Now to capitalize on this, I buy a 1900 put option expecting a good downfall based on charts or what have you. I just saw Reliance chart and maybe I see a bearish momentum on the charts and I expect a good downside, maybe a fierce downside due to the news that has come recently about Mukesh Ambani's health and also the past quarter results. So what I did was I bought a 1900 put option. Now I'm completely hedged. Why? Because the lot size of Reliance is 505, and since I bought a 1900 put option, I'm completely hedged on the downside, and even if Reliance goes even to zero, I'll make the entire 1900 bucks because I'm completely hedged and I will get back my 1900 points if that happens, which is very unlikely, but just an example. Now let's just say that Reliance falls to 1800. I lose 100 points on the investments that I bought, but I cover at least 80 to 90 points by buying the 1900 put hedge. Now why will this happen? Because around the time that I will buy the 1900 put hedge, the price would already be at around 20 to maybe 30 rupees. So when I buy the 1900 put option at 20 to 30 rupees, when it falls down to 1800, the price might be around 100 rupees on expiry day, since the put option has to expire. So I have covered that 70 to 80 points by buying the 1900 put option against my investment. Now this is how an investor would hedge their investments. Now let's cover the advantages and disadvantages of hedging, and you will know if hedging is for you or maybe not. Advantages are you are protected from a black swan event like corona, demonetization or surgical strike. There are two types of events. First are known events and second are unknown events. Unknown events are maybe corona, demonetization and surgical strike. Corona, you can even say that it's predictable because you can see the world getting infected from corona and the fall had started because of corona, so you might just get an idea. But demonetization and surgical strike are completely not in our control because they can happen overnight, right? Second point is losses from trades or investments are minimized through hedging, as we saw in my trade of 12,000 call option that I had shorted, and also in my investment of Reliance. I was completely protected. Even if the 12,000 call option did not give me money, I'm at least not exposed to the upside completely. And in the Reliance position, I cover my downsides by buying a 1900 put option. Third point is if the view is short term, I can make more money from hedging than just by sitting it out, especially in investments. What does this mean? That if my view on Reliance is shorter term, what I can do is sell a maybe 2000 call option instead of buying a 1900 put option, which will give me the credit that I receive on 2000 call option. Whereas longer term, I am bullish on Reliance, so I'll make money there as well if Reliance moves up. So I will actually end up making more money than if I had just sat it out. Fourth point is I can use the hedge money to buy more stocks. Let's say I shorted 2000 call option of Reliance and I collected maybe say 4 or 5,000. I can buy more 2 or 3 stocks just by doing that. So these were the advantages of hedging. Now let's dive into the disadvantages of hedging. Every hedging strategy has a cost associated with it. So before you decide to use hedging, you should ask yourself if the potential benefits justify the expense. What do I mean by this? Let's take the Reliance example again. Every time I hedge my position with a put that I buy or a call that I sell, I am exposing myself to more risk, because let's say my analysis goes wrong and Reliance moves to the upside instead of the downside. I'm exposed to losses from the 1900 put option because I'll be losing money over there. So hedging always comes with a cost because you never know when the market might move, right? Second point is, remember, the goal of hedging isn't to make money, it's to protect from losses. As traders or investors, we get very fearful of losses, and what we do is end up hedging most of the times, and it is not necessary that our view goes right every time. So we should always remember that the goal of hedging is not to make money, but it's to protect losses or at least minimize them. Third point is, if you are always hedged, you won't be able to make money from your trade or investment all the time. Like we discussed on the first point, hedging always comes with a cost, and if you are hedged at all the time, especially in investments and maybe even in trades, you won't be able to make money that a normal investor that just sits it out would. Because let's say you do a iron condor versus a strangle, you will obviously make more money in a strangle rather than iron condor, but obviously you are more exposed to losses in the strangle as compared to the iron condor. So you have to choose your situations and what to implement and when to implement them. So this was the video on hedging, guys. I hope you all liked it. Make sure to subscribe to the channel if you like this video, share it with your friends, and I'll see you in the next one. Bye bye.